Today I'm joined by Piragash Sivanesan. He's a debt advisor from Totum Finance, and we've got a load of topics we're going to cover. We're going to talk about the impact on the market, who's exposed, what they can do about it, how they can rescue their deals. We're going to be discussing reputations, and he's got some really, really good tips and insights, having worked in a bank previously, advice for investors and developers concerning how they survive in this market and where the opportunities are coming from. Welcome, Piragash. How are you?
Yeah, good.
So let's jump straight into it. What do you see as the impact on the market so far from the lenders and debt advisory perspective?
I think everything so far is reactionary. These are unprecedented times, and so we've seen lenders pull products, but not because there's a particular risk issue or there's a feedback of losses. But actually, they're doing it because they're just so busy, because everyone's asking for holiday repayments.
Now,
and they're asking for...
When you say it's unprecedented, is it unprecedented? We've seen recessions before, and everybody says it's unprecedented, but we've had pandemics before, we've had recessions, and we've had credit crunches. What makes this any different?
Well, I would say, yes, we've had pandemics before. I can't say I've lived through a particular pandemic in the UK. The second thing is, we've never seen 3/4 of the economy shut down. We've never seen a pro-conservative capitalist government put in a huge number of social measures to protect people. So, and the knock-on effect of that is, for example, I remember speaking to banks literally the weekend after a lot of these announcements had come in, and you're saying to the banks, right, so how are you going to help? Are you part of the Siddell scheme? How are you going to look at potential issues that are clearly coming on for developers that we're working with? And they didn't have a framework, because the thing about banks is that they are a system of administrative processes. Banks love a process. They need a committee that then approves something for another committee to then approve it. If you try and get a new product approved in the bank, it takes months and months and months. Now, what's happening now is people's needs are immediate. People, if 3/4 of your client base is calling you today with urgent inquiries which could save their business or promote their business, that is unprecedented. Banks don't know how to deal with that. And a theme I think that is worth exploring across this piece is how important the leadership is of each of those institutions. We've seen politically how important leadership is, whether you compare someone like Trump versus someone like our own Prime Minister versus, say, other political leaders across the world. Sorry about that.
Well, there's a bit of delay here, so we'll have to try and cope with it. You've touched on quite a few things there. At the moment, the banks and their processes, can they respond quickly enough, or are they overwhelmed? Have they pulled up the drawbridge, as it were? And also, let's not forget Boris Johnson. I seriously hope that he's going to pull through. But last night, he was moved into intensive care, and who knows, by the time this video goes out, his condition could have improved or worsened. So, we are kind of on a bit of a cliff edge here. But tell us what you've seen as far as the products are concerned. Are products being pulled? Are products being launched?
So I think I would say it's safe to say that the majority of lenders have reassessed what they can do. But that isn't because of a absolute feedback in credit deterioration, for example. I think that's more a response to the fact that lenders that are open are seeing a huge amount of demand for new deals, and so they just can't cope. So therefore, they're having to manage that by doing two things: immediately bringing the kind of loan to values down. So we're definitely seeing some of the covenants, the amount of risk that lenders are taking, reduced. But again, not across the piece, and it's complicated. So in the first instance, it could be because there's an immediate feedback from someone in terms of the amount of requests, but also because there is a little bit of an unknown. Debt in particular is all about taking measured risk with a set of unknowns that you try and manage. Now, when those unknowns increase, it's very difficult to make a credit decision. We're talking about returns here between 3% and maybe 10%, depending on the type of debt. And it's very difficult to make those types of decisions if, for example, you can't get a valuation, or your monitoring surveyors are unable to go and value something on site. So once you bring a lot of those variables in place, it makes it much tougher, and it's easier, definitely easier, to just reduce the loan to value and pick the best deals.
Now, I want to touch on your experience, because your experience is particularly, I mean, this is the whole reason why I've invited you onto the show, is because you used to work for one of the major banks. You were there through the credit crunch, so you understand how that works from the lender's point of view. And in my mind, the developer's always wanting his costs covered because he's got to pay for stuff. But more so than ever before, right now, the banks are worried about their exposure to GDV. So they're lending against GDV, and the developers wanting to have all his costs covered. So it's how those two meet. But what's your experience? Which bank was it you worked for before? Was it RBS?
RBS and Lloyds.
Those two pretty good banks to be at during the credit crunch if you wanted to gain some experience. How do you think that experience translates to what we're seeing now then?
I think ultimately the way in which banks think is simply to protect their debt position. You know, they're not in the business. They're not capitalized enough to make huge losses. It's not like a fund that may take a view that a quarter of their or 20% of their portfolio is actually going to create enough value to cover the rest of the 80% losses. A bank doesn't work like that. You know, a normal high street bank, and the bit that's probably a little bit different from 07, 08 is the sheer volume of alternative finance that we're in today versus 07, 08. You know, in 07, 08, I think, and even in 2000, the number of alternative providers was quite small. Today, we've got the proliferation of the peer-to-peer market. We've got debt funds, which have really expanded over the last couple of years. Why? Because in a low interest rate environment, and also where, for example, the equity markets have perhaps been a bit more volatile, we've seen a lot of money come into debt, where they've seen a secured position with potentially a return of anything between 5 and 9% being quite attractive. Now, in the good times, brilliant, that money's coming in. But now, high street's going to react differently to a debt fund, to a peer-to-peer. And that's really what a developer's going to be thinking about.
I mean, it's got to be a great time for a small team that's nimble and operating efficiently, working from home, let's not forget, versus a big bank who's got legacy systems and they're all dialing in and it's all a bit disconnected. I mean, some of my clients need to refinance stuff and some of them need to get some debt on there. You and I have looked at a couple of cases. Some people are kind of a bit stuck, and they've approached us to see if we know any investors that might help them or what have you. And I did an interview with one lender, and they're absolutely inundated with inquiries now because they are lending. Do you think this scarcity of finance is causing a spike in rates being affected?
I think from talking to lenders, and generally, you know, we deal with quite reputable lenders, generally they're not seeing this as an opportunity to just price hike. And I think that's because of the nature of this particular pandemic. I don't think it's morally right to just, you know, completely take the advantage of the current situation.
Well, the vultures are going to be remembered, right? I mean, you're absolutely right. People are dying. People are losing loved ones. I know but I know several people who've lost people that they really care about, and you need to be empathetic. But at the same time, it's business, and if there's a price for something and they're taking risks, then it's a tricky one, isn't it?
So on that point, so then it's a really interesting point, right? And smarter people than me will work out the point at which risk versus return and which is more important. And I would say you can take calculated risks with higher returns if you truly understand and are able to predict what's going to happen. I think taking, you know, even charging 24%, 25% on senior debt, for example, if fundamentally there's a lot of risk associated with that deal, it is not necessarily great debt management. So I have seen lenders in the round sort of, you know, 1% bridging loans, maybe at 1.1, maybe an arrangement fee slightly higher, but nothing too penal, really. I think also, though, at this moment, if I am a developer, if I'm a borrower, if I'm an investor, I've got to say, do not put your eggs in any one basket. Things are changing on an hourly basis, right? So every lender that you speak to that's open, they are definitely going to be open to considering your proposal. But the sheer volume of stuff that they're looking at means you cannot just rely on that one lender. As much as possible, you've got to look at others. And you can't think so binary. You can't think, this is my deal, it's 60% loan to value, can you fund it? You've got to take a step back and you've got to think, okay, well, maybe I have to bring in equity so this becomes a 50% loan to value deal, even though there's the potential for 60%. What if a valuation comes down? What if the lender can't do it at the last minute? What if through the 4-week credit process, something happens which lowers and alters the risks?
What if by the time
your development's got to work?
Yeah.
Sorry, Matt.
What if by the time your biz dev guy at the lender or the bank or whoever it might be actually takes it to the credit committee and they've changed their mind because lo and behold something catastrophic has happened, which, just look at the situation with Boris. But at these sorts of prices, at these sorts of rates, it's not a good time to be geared up, is it? And let's talk about exposure for a bit. In this market, who is exposed? Because investors and developers might be at different stages with projects, and this disruption is sort of instant severance of supply and demand of services and all sorts of things. It's very it's very dramatic. But who do you think is most exposed? Or what are you seeing?
I think ultimately anyone that is on a highly geared development product or even a bridging product, and who have little choice to move. So let's take construction, for example. If you're halfway through a project and you, for example, either have to shut your site down, you can't get supplies, those costs of supplies may increase in the future. So if we take first shutting down, if you have to shut down at all, you are now at the mercy of your lender. Why? Because, so let's just say you've got another 12 months to go. In your view, I shut down, it's all right, I'll make it up. But the calculation the lender is making is, okay, well, we've apportioned maybe a set amount, say 200 grand of interest across this facility. Because remember, construction or development finance, the interest accrues every month. So that's the amount they've got. Now, if you shut everything down for a month or even 3, what happens is your interest increases. Now, they know that you've only got enough if everything follows your plan, follows your budget. So you can't just shut it down. The question you've got to be asking your lender is, what do you intend to do with interest? And hopefully your lender is supportive. But they can only be supportive.
When you say supportive, you mean they'll add it to the facility, right? Increase the facility.
Yes, exactly.
But I know what you're going to say now. They can't necessarily always do that because
if they're at policy, so say, for example, if you've gone to a lender, you thought you've got a great deal because you've only put in 25% equity and you've got 75% loan to cost, whatever it is. And now you're saying, can you give me an extra 50 grand, please? And they said, well, we'd love to, but actually we can't, not because we don't want to help you, but our funding line is built on absolutely sticking to this credit policy. And if we trip that, this becomes a default scenario.
Yeah.
So now, even though we want to help you, I'm not sure we can. Actually, we want you to service it. What? And that's that's one of the worst things on a construction site, because there is no cash inflow. And so for you to have to fund interest at the same time is difficult. So what are your other options? Maybe you can bring equity. That equity is going to be really expensive now because they know they're taking the absolute most amount of risk. So it's playing all of these things. And unfortunately, to go back to your point, Matt, which was the higher leverage you are, the fewer your options you truly have, because you have very little profit to give away. Even though that profit is in the future, you have very little of it if you're highly geared. And in terms of bringing in other debt providers, etc., that's difficult as well because you're already highly geared. So in that situation, it is understanding it very, very quickly. What type of lender do you have? a very strong private fund may be able to absorb that versus peer-to-peer. I'd love to speak. Sorry, Matt, you were going to ask.
Well, no, hold that thought. But
Okay.
they might have been up against their policy limits when they issued the loan, and if they weren't then, they probably are now, right? So your only solution is to top up the equity, and if you haven't got any equity, where do developers go to for this lifeline that's going to save them? I mean, this is where the developers who've lived through a bit of a squeeze, who've gone through. I went through my squeeze when we voted to leave the EU, and I was terribly exposed, and I learned the hard way. Previously, I got all my decisions. I called them right. I called the credit crunch right. I started businesses and sold businesses, and always got my timing right. And I'm glad I got my timing wrong and only lost the amount of money I lost, so I didn't screw it up later on. But until you've experienced that, you're not as experienced as other developers, really. So where do they go for this lifeline if it needs an injection of equity?
Okay, so the first thing I would say is, I know you want me to talk about equity, is you've still got to work with your lender. Whatever you do, you've got to work with your lender. Even if your lender can't actually support that increase in interest, you've got to work out something with them. And to be honest, nothing can happen right now today. The lenders can't take any action. I think the government have supported you. So there is probably, a 6-week period, for example, for you to try and negotiate something with your lender, whatever, even if it's the smallest help, you still absolutely need to talk to them, because if you don't and do something on your own, that may not be enough. So that's the first thing. The second thing is, you've got to consider what value is truly in the site. You can only trade more money, more equity, anything, if you have something of value to trade with. Now, that could be, in the first instance, if you do have a very profitable scheme, it could be your future profits. So it could be about bringing in another investor, another partner to come into this. You may want to do a kind of, maybe reduce some of the debt today in order to give more of the equity to someone tomorrow. But it's also about thinking laterally. Look at your site. Is there something more that you can offer? Is there an extra planning maybe that you can offer up? So it's hard.
They've already done that. They've done that when they bought it.
No. So what I'm
saying, they
saying,
don't suddenly wake up in the morning and think, right, this is great, I can get another 6 apartments on there. I never realised that.
If you don't have any other options, you don't have any other options. But don't forget this, because, for example, you may have a PD site that you're converting, which may have an outside chance of an airspace opportunity, right? I'm talking about you're highly geared. There's nothing else that you can do, right? But maybe there's an outside, maybe it's a 30% chance of a airspace deal being put on there. So you do have to do your maths and consider, whether that's likely. But you can take that to an investor and say, look, the current deal as is means that actually I can maybe offer you a 20% return on your extra money that you're giving. Now, in today's market, that might not be enough for an investor, but you can also say, we will put in for this airspace planning. These are the risks, but I'm willing to give you 80% of that upside.
Yeah. Now, or hopefully you haven't given second charge to someone else already, and you can say, look, put in the equity. You can have second charge, which basically means that the equity that you've already got in there is pledged as collateral, and that gives them a buffer. And and hopefully it'll pull it off.
And there's even right to be, obviously I've done restructures at the bank, and there are times when your bank will not be able to lend anymore, and we've been in these situations. But for example, there's a cash gap, and maybe the cash gap is, let's say for sake, 50 grand, right? The 50 grand will allow the project to continue and finish. There is a scenario where you say to the bank, I have an investor that will absolutely plug this gap of 50 grand. But in order to save the deal, I appreciate that you would help me if you could, but because you can't, would we be able to borrow that 50 grand from somebody else, and the capital at least becomes super senior? So actually, when this is all sold, the first person to get repaid is actually the super senior.
Oh, really?
Not the senior, right? And it's another way, because if you're borrowing 50 grand and it's going to allow the project to finish, there is value in the bank for that. But they might not be able to help Now,
That's
again,
got to be a great move if you can pull that off. If you can, I mean, in a way, you're kind of holding a gun to the bank's head, aren't you? Not literally. Don't anyone do that. But if you say like, look, without this guy's money, the deal's stuffed. You're going to have a load of work to do. You're probably going to take a bit of a haircut on your loan. But yeah, give him super senior and.
To bring life stuff, to compare that, right? To make it an analogy. Everyone's seen what's happened with Liverpool Football Club, deciding to furlough, not deciding to furlough. But the Premier League came out and basically put together a really interesting package. And I was watching Carra and Neville on Sky Sports.
Don't go too deep with the football, Piragash, because we'll lose people. But I'll let you get it off your chest. Fine. Go on, what's the footy? What's the analogy?
So the football, the Premier League came out and they basically communicated that they'd agreed this whole big deal, and that the players, on the Friday, they agreed that the players would take a 30% salary cut. And then they called the players in on the Saturday and told them this. As you can imagine, because they didn't deal with that properly, it went really badly. So this example that I'm giving you only works if you work with all your stakeholders. That means your investor, your lender, your contractor, everybody. Because if you're going to be creating something like a super senior, you've got to get everyone on board. It's not easy.
Yeah,
even if it makes absolute sense.
You just need that little bit of cooperation from everyone, a piece here, a piece there, and that adds up and puts the whole thing back on track. And we are in extraordinary circumstances. So you wanted to talk about peer-to-peer. What was it you wanted to mention about the peer-to-peer market?
So look, peer-to-peer, I forget the numbers now, but I think across business, property, etc., has lent something like £11 billion out to SMEs. Right? It's been a significant change for borrowers, and I think particularly in the SME space, the use of technology has made it really, really interesting and easier for borrowers to borrow money, and also for investors, it's been a boon. Unfortunately, they've only ever known good markets. But today, peer-to-peer is not a bad product at all. And in fact, I'm a big supporter of it. But this is growing pains. Going through a cycle is growing pains. And unfortunately, if you're a developer and you've got a peer-to-peer lender that supported you, the mechanics of the product means that every drawdown, they have to go and raise that money. And at a time when investor money is being pulled, it's really difficult. Really difficult. Now, if I was going to go into a peer-to-peer loan today, I would look very, very closely at the impact of market dislocation and an inability of a fund to fund me. Because what it does is, again, like we talked about before, it increases the interest costs, right? And I would want to know that the platform is there to support me, that it's not merely because if they haven't performed, I need them to work with me, because I will certainly work with them. And it's something that is not the easiest, because as you can imagine, investors in that fest pot will start to want their money back.
Yeah.
And it's really interesting how that plays out.
Do you know what I'm seeing? Like, never have I ever thought that it's so important to know who the players are, understand how they operate, understand who the good players are and who the bad players are. There are some people out there who would claim that they can rescue your deal, but they're, wolf in sheep's clothing. There are some lenders out there that would claim that they can perform, but really it's just marketing and biz dev. You've really got to know who's going to come through for you. And, that's what we do with the club, with Qandor, is just that kind of inside knowledge is really valuable in times like this more than ever before. And actually, this is when I've made, you can tell a lot by someone by the friends they keep, but also by the friends they don't keep. And it's times like this where I really work out who I want to hang around with. What's your thoughts on like property as a whole in times like this, and the leadership that it takes to get it through these moments?
I mean, Matt, we're all in property here, right? And one of the things that I think I really want to make sure and ask the community that is our property market is that at this time, I appreciate that everybody has their own risk that they have to look after. I mean, that could be boiled down to as an individual wanting to know whether you can make your mortgage payments, to a company that has to ensure whether they can protect all of their employees, a brand For example, we've seen RICS come out and support and try and protect all of their surveyors in terms of the ability for them to value at this time. We've seen lenders make decisions in terms of bringing loan to values down in consideration. But the one thing that I want is I want more leadership. We've had so much analysis. What do previous cycles look like? How can we possibly value something? But if we can't actually go and visit it, if we can't look at comparables, what are the comparable data? But through all of that, and I think the comparable that we need to make is our political leaders, is our business leaders. When Rishi Sunak came out and made such a bold decision to protect a large swathe of the economy, he did it. Well, we'll see what happens, but in my mind, he made a great decision. And equally, as property people, we need to protect this market. I think we're in danger of talking it down so far that before we know it, the only people that can manage in this economy or post this crisis is the vulture funds. And I'd hate for that to be the case. I'd love to see more collaboration between lenders and RICS, between the Association of Short-Term Lenders and RICS, saying, look, we understand that our normal relationship is us, we have to sue you if things don't go right. But in this case, I want us to be more collaborative. I want us to use different benchmarks. Use people that are far smarter than me to create frameworks that give people confidence. And I think that's what's being cried out for right now. People remember that. People will absolutely remember that.
No, for sure. But I mean, imagine if we were going through this and it was 1996 or something like that. Most people were only just getting their first email address in 1996, but suddenly the whole world's working from home. Internet speeds are nice and fast. We're all using technology to stay connected. But more so than ever, the industry itself is more transparent than it's ever been. So quite frankly, if you decide to do someone over in this market, you're probably going to get found out, and good luck trading over the next year, 5 years, 10 years, because reputations, I think, can be made or broken in this market. And fundamentally, I think the good people will thrive, not just survive. So, Piragash, it's been great to have you on the show. I think we've covered quite a lot of ground there. Is there anything that you want to leave us with? Is there anything we haven't covered?
No, I mean, I guess the one thing we've not touched on is preservation of capital is absolutely critical. You can think about the things you're going to do to invest on new deals, etc., in the future, but as of right now, focus on your preservation of capital and your cash flow. They're the two things that I think every transaction that you're trying to get out of, every new transaction that you're looking at today, it's so important. The government, there's been various bailouts, but it starts with you. What can you do to protect yourself? And, I've already made it open to Qandor members and obviously wider thereafter. Anybody that kind of needs our support, we're happy to have a free call to understand how we can help them.
Do you know what? I noticed that we've got a members only online forum, and I noticed you putting that out there, and that's exactly the sort of thing that's needed right now. And the team that helps me run Qandor and the team that's helped me launch Tropolis, innovation has been the theme for the last few weeks for us. And in actual fact, whereas a few weeks ago I was really worried about Qandor, I was thinking, well, we all know that the property market is cyclical and that there's going to be booms and there's going to be busts. And I've structured the business accordingly. But I wasn't quite ready for something as dramatic as this. But we were able to respond really quickly. There was a few people that had quite large fires that they had to go and fight. But there's also been some really good people coming out of the frameworks. Either they're seasonal property investors because they've got other businesses that they tend to run, or they're new players who've just been waiting for the market to correct because we've been in this bull market for a very long time. And in actual fact, I know we've got some challenges to get through, but we will get through them. And there's going to be opportunity, whether you're comfortable saying it or not. I always try and hold it back. There will be opportunity.
I couldn't agree more. And I guess, when you ask me that question, what should we end on? And I think that's the property market, supply and demand hasn't gone away. This is still a great market in the medium term. And it's why we're all passionate about it. It's why we're all heavily invested in it. And I think we should positively see those opportunities going forward. But for now, just get your house in order and make sure you can stand the test of time. And I think there'll be some wonderful opportunities.
I think on that note, I'm going to say thank you very much, Piragash. It's been a pleasure talking to you. We've covered loads of different points there. Have a good day. Thanks once again.
Thank you.